Well, good afternoon, everyone, to the latest edition of the Officials. Please like and subscribe in YouTube. And if you don't like it, let us know. We're always ready to listen. We have a few issues to discuss here today, and I will start from the high level. The oil markets have been correcting. And if you have been reading the officials, you have seen that we have taken a point of view that is, I would say, fairly negative on the global state of the economy and, by definition, on the oil markets. And I want to explore some of those issues. The critical one is China. In our opinion, and based on the data which is public that we have access to, and maybe some other direct data we get, all the indicators are fairly negative. One of the things that has been attracting our attention in the last week or so are results by Western companies for the first half. And we actually look very closely at a couple of CEOs that had decided that they had enough and they were going to spend more time with their families as they should. And this, I guess, job resets happen because the targets for the sales in the first half in China were below target. If we extrapolate and look at the behavior of other indicators in China, one could almost conclude that China is contracting. So what are we looking at? We're looking at results at the retail level, companies that sells bags, just things, including cosmetics in China or drinks, and they're really not doing well. If we go a little bit deeper into industry, all the Western companies that sell cars, combustion cars primarily in China, are contracting. Year on year, they're doing really, really badly. And if we look at the construction sector, well, we all know that China really is not doing well. And that means a lack of demand for copper, lack of demand for cement, lack of demand for petrochemicals. So one of the key issues that has been really worrying us immensely is that lack of petrochemical demand. And we are going to talk with the rest of the officials here in the next couple of minutes, but let me finish a little bit more with that. In our conversations yesterday, we talked to a major Chinese conglomerate in the oil market. And they had an expectation at the beginning of the year or a 500,000 barrel per day growth in oil demand. As of now, they are barely at 200,000. They have changed their expectation. And we were, in a way, a little bit lighthearted in how we were communicating, but we're saying that we wouldn't be surprised if we go from 500 to 200 to minus. And when I talk to other Chinese teapots, besides the major conglomerates, they're also in the communication almost hoping and wishing that some of the outside consultants who have been bullish on China prove correct. But all the indications are that they are grossly incorrect. So I wanted to start with Mr. Wu, who has been a little bit bullish and I think perceiving that China is going to do well, or maybe some other indicators, but I think instead of just all of us being bearish, we need a little bit of good news. So why don't we start with that?
For sure. Of course, there are still some bullish factors in the oil market, but we can't discount the bearish story out of China. The economic data does not paint a very optimistic picture, and of course, there's a lot of pessimism around the property market. There's some structural issues within the economy, but oil market involves a lot of other stuff too. So, for example, traders will be looking in a wait and see mode going into Friday tomorrow, looking at what Fed Chairman Jerome Powell is going to be saying at Jackson Hole Symposium, giving forward guidance of the interest rate monetary policy in the coming months ahead. So traders are anticipating a rate cut in September and potentially more how this rate easing cycle will go. Furthermore, you have OPEC potentially. They will be looking to keep a price floor of around $80. So potentially they will come out to communicate that actually the plans to bring back barrels into the market in Q4 will be delayed into 2025, which the market would take as a bullish sign, because we think that some traders have been pricing, expecting that OPEC are going to bring back barrels, but a reversal will be a bullish indication. And what's more, you have some okay economic indicators from emerging markets such as India, as well as the market positioning. So currently the long to short ratio in Brent futures via hedge funds are on the low side of historical levels. So what this means is that is there more risk capacity by money managers to sell even more, and Brent's always found a support level in the low 70s or in the mid 70s right now, and we think that the support level could prove to be very important going forwards.
So, Dr. Wu, the key issue that you have mentioned is the potential lowering of interest rates. So let me ask the very difficult question to Harry. By all indications, tomorrow, Mr. Powell will give a speech in Jackson Hole where he will signal that an interest rate is coming. Maybe. But by all indications, he may do that. If he does that, is that a bullish signal for the markets, or is that an acknowledgement of an economy that is falling out of bed? What is your interpretation, Harry?
I think first and foremost is that Jerome Powell's speech is coming, as you said, tomorrow on Friday, and it comes on the heels of the release of the previous FOMC meeting minutes.
Yes.
And in these minutes, the majority of participants have acknowledged the need for an interest rate cut, something that the pricing of overnight interest rate swaps has been indicating all along. So at the end of the day, what the market will be paying very closely attention to is as to whether we will have any hints on the Fed potentially moving more than what is currently priced in. So more than a 25 basis point cut. And the speculation around why the Fed would do that is, of course, the labor market. So you know the Fed has to thread a very difficult needle in its dual mandate, being able to bring down inflation to a 2% target, which it has not yet achieved, while making sure in a scenario of a soft landing that it doesn't crash the economy in doing so. So Fed Chair Powell tomorrow in his speech, if he does give guidance, I think people will be looking for whether or not the Fed is going to surprise us. Will it leap to 50 basis points, considering the most recent labor market data that we have? And that's really the question. If we get a confirmation of 25, that's not going to move anything. It's baked in.
So it's neither bullish nor bearish, but a continuation of the kind of weak markets we have.
Yeah. So if we're looking for any kind of surprise out of Jerome Powell, and again, I don't actually, think that he is the kind of person or the Fed in terms of its behavior to release any kind of indication as that they would go maybe above and beyond what is priced in, nor is it necessarily the Fed's reaction function to be leaping into a 50 basis point cut. But if there is even a hint of that, I'm sure that that's going to reinflate the sales, put some wind in the sails of risk takers who may then decide to be a little bit more optimistic on the price.
So let me put Will on the spot. So it's between 25 and 50 basis points that we are expecting a signal and maybe an actual lowering in September. But you were, over the past couple of days, I noticed, very, very focused and excited about a reset, a reduction, a correction in the labor force. And you were expecting and focusing on that and running around saying that there's going to be a correction on those numbers. So something happened. What happened?
Yeah, exactly, Jorge. So we saw the BLS come out with their annual revision, and it was a big one, down 818,000 jobs for the year through to March 2024, which works out at about 70,000 jobs per month. So yeah, a huge big knock to where we thought the labour market was.
So this is a reduction on what we thought we were and got reduced by nearly 1 million jobs.
Exactly. So current non-farm payrolls, for example, are benchmarked off of the March 2024 number. So a revision to that affects where we think we are right now. And yeah, it was a big one.
And Harry was talking about the dual mandate. So this means that Powell needs to be concerned about unemployment, which in a way these figures are telling us, right?
Well, yeah. I mean, in essence, the question is how much weight the Fed is going to put to the revisions that the Bureau of Labor Statistics has come up with. So what it's telling us is really the pace of job creation in the non-farm sector has been a lot slower than what has been measured to date, right? And at the end of the day, a lot of the conservatism around how the Fed may evolve its policy rate was centered around the fact that unemployment, while rising, was only rising slowly. So there was margin, there was scope for the Fed to continue cutting rates at a conservative pace. Now, this very big revision begins to raise questions as to whether or not they could still hold off or whether they need to act because people think that they're behind the curve. That's what the bottom line is all about. How are they going to weight these BLS revisions in their decision-making process? And is Fed Powell going to acknowledge the revisions when he speaks tomorrow?
Because another thing that we have been noticing is that the gasoline market is not performing as we were anticipating, and the 3-to-1 crack has declined. And one of the main elements has been the gasoline performance this summer. So maybe switching a little bit to first Will and then Dr. Wu, what have you been seeing in this 3-to-1 crack?
Yeah, I mean, the 3-to-1 crack, from what I remember, was at February 2021 lows. So it's really come off. It's really hammered. And a lot of that has been lackluster gasoline demand. I think driving season was disappointing for a lot of people.
And let me give you another bad news. I was talking to my sources in Asia this morning. They're waiting for the release of the new set of export quotas from China. And guess what? You're going to have more diesel and more gasoline in the next few days being announced. If this happens, the 3-to-1 crack gets whacked again. So what's happening in China? Tell us more, because it really doesn't look good, man.
No, so yeah, people will be anticipating the release of the product export quotas out of China, expected, I suppose, next few weeks, early September-ish. The expectations that there will be more exports, which logically indicates a weak domestic demand, but it's also incentivizing more refiners to keep up there, to sustain their run rates. So what this could mean is that this could spur some crude demand in the spot market. So in the physical market, we could see some more buying in, for example, in Dubai crudes or in
we're going to go there in the
that.
closing point.
So that's a bearish but bullish point of view.
So
I think,
I see Harry ready to tell us something.
I think we just need to be a little bit cautious about how we talk about China. And I appreciate Vincent's enthusiasm, but higher export quotas could also be simply a release valve for excess product made in China that is not being consumed. So we need to be careful about extrapolating any increase in quotas into an increase in runs. The latest data for July show lower crude oil imports. They show lower runs, certainly year on year for China. And a lot of people, consultants, sell-side research and banks, and even including ourselves, are looking for a profile in Chinese crude runs, which is well below what we would have thought even mid-year. So the situation in China in terms of crude demand, and then as we're going to be talking about in terms of ramification for demand for crude, is one of these questions where you're going to have to think, are they going to hold back? Or will China, if the price of crude is sufficiently low, so looking at a more bearish scenario, will still buy the crude for restocking purposes because it is a behavioral trait in terms of Chinese buying. So they may not refine it, but they know they'll need it down the line. They will restock if the price is attractive. But all in all, China, I think, as you rightly point out, initial expectations 500 KBD growth this year, progressively revised lower. I don't think we're going to contract for the year as a whole. If China comes sufficiently close to a 5% GDP growth target. But what is evident is that a lot of the forecasts, and you highlighted this, I think, extremely well, Chinese demand growth in everyone's forecast is predicated on two products, jet and petrochemical. So that is naphtha. If the economy fares poorly, one of the biggest legs of support, right, petrochemical sector and its demand for naphtha is going to go away. And that's where we could see maybe a flattish, more contractionary scenario evolve when it comes to Chinese demand. And if that's the case, that crude demand that's anticipated from China may simply not be here by the end of the year.
Well, I appreciate that. And I wanted to close up with some thoughts. The flavor we have here is of a market, in China in particular, that is not doing so well. In this kind of situation, we would expect the Asian benchmark to underperform, meaning Dubai. My colleagues here have been telling me that there is, however, an overperformance in Dubai, where if you see the spread in the front end, the physical versus the first month in Brent, that spread has been closing in, meaning that Dubai is stronger than Brent. Why is that? Well, we are not too sure, and we're scratching our heads literally. Why is this happening? Because if Asia is underperforming, Dubai should fall faster than Brent. We have seen critically a company, Vitol, and another one, Gunvor, buying a lot of partials, having a lot of convergences, and we still haven't really uncovered why. One of the thoughts that has come across is the Yulong refinery in Shandong, but we also heard that they bought some term Saudi as well as Espo and Sokol. So we're going to be monitoring this because we want to make the markets more transparent, tell you who's buying, who's selling, and if we find out why, then we will also tell you. But we won't be shy in telling you who is buying and who is selling. With that, I hope you appreciated this episode of The Officials, and we'll see you next week. Thank you very much.